Welcome back to The Financial Architect, the podcast dedicated to helping you build a stronger, more resilient financial future. I'm your host, Alex, and today we are pulling back the curtain on one of the biggest, yet misunderstood forces shaping your daily purchasing power, the US Fiscal Deficit. It's the secret Wall Street often ignores, but you shouldn't. To help us navigate this monumental topic, I'm delighted to welcome a seasoned expert in global macroeconomics and financial strategy, Jane Chen. Jane, thank you for joining us.
Thanks for having me, Alex. It's a pleasure to be here to talk about what is truly the invisible force in global finance right now.
And that's a perfect phrase for it because, Jane, I think most of our listeners, myself included, see the headlines about inflation. They see the Fed raising or lowering rates, but they often miss the connection to the Washington, D.C. spending machine. Why does this topic, the fiscal deficit and the resulting public debt, matter to the person just trying to buy a tank of gas or save for retirement?
That's the core of the issue, Alex. It matters because this debt is the structural tectonic plate beneath everything else. Think about it this way. People worry about the day-to-day weather. That's the Consumer Price Index, or CPI, the short-term inflation measure. But the deficit is the long-term climate change. Even if the Fed gets the monthly inflation number down, if the underlying structure, the government chronically spending more than it earns, is never fixed, that debt exerts a constant upward pressure on prices. It slowly but surely erodes the value of every dollar you hold.
So it's not just a boring economics textbook concept, it's the invisible weight on our savings.
Exactly. And because the US dollar is the essential pillar of global commerce, you use it to buy oil, to settle most international transactions, if that pillar starts to wobble, we all feel the tremor, regardless of what currency we're paid in.
That brings us to a foundational concept. Jane, can you clarify for our audience the critical difference between the fiscal deficit and public debt? It sounds simple, but they're often used interchangeably.
That's a crucial distinction, and I like to use a simple household analogy. Imagine your entire household budget is the U.S. economy. The fiscal deficit is the flow. It's the monthly snapshot. Did you earn $5,000 this month and spend $6,000? That $1,000 gap is your deficit. It's the current overspending.
Okay, and the public debt?
The public debt is the stock. It's the historical photo album. It's the cumulative total of every single deficit you've ever run, minus any rare surpluses. So that $1,000 monthly deficit gets added to your total accumulated debt. The impact on the dollar, crucially, isn't just about this month's spending. It's about the global market's perception of the sustainability of that thick, historical album. Is the Titan capable of paying this enormous pile back?
That makes perfect sense. And the U.S. deficit is structural, meaning it's not just a bad spending month, but an inherent yearly problem. Why is that? What are the biggest drivers of this chronic gap?
There are two main buckets. First, you have mandatory spending. These are massive, legally committed social welfare programs. Think Social Security and Medicare. They automatically grow as the population ages and healthcare costs rise. Trying to reduce these is, frankly, a political near impossibility.
The automatic growth factors.
Precisely. The second bucket is discretionary spending, the annual budget Congress approves for defense, education, transportation. But increasingly, the third and fastest growing category is debt service itself, the interest the U.S. must pay its creditors.
That's the compounding effect kicking in, isn't it?
It is. If your debt grows, your interest payment grows. And if the Federal Reserve raises interest rates, which it has done aggressively recently, that payment spikes dramatically. When more and more tax revenue is funneled toward just paying interest, less remains for productive investment, and the global market sees that vicious cycle and scrutinizes it intensely.
It signals that the safest enterprise is approaching a state of over-indebtedness.
Absolutely.
So, Jane, we know the deficit is big and persistent, but let's get into the mechanics. The deficit requires the government to borrow money by issuing treasury bonds. The key mechanism you mentioned is how that deficit is financed, and that's where the Fed steps in, often with what's popularly called printing money. Can you break down the monetization of debt for us?
Yes, this is the most critical and often misunderstood part. When the U.S. Treasury runs a deficit, it sells bonds to borrow. Most are bought by foreign central banks, pension funds, and investors, But sometimes, especially during crises, the Federal Reserve steps in, primarily through programs like quantitative easing, or QE.
That famous acronym.
Exactly. QE is when the Fed buys these Treasury bonds on the open market. They're not using existing tax money. They are essentially injecting newly created reserve money into the financial system. Now, technically, they're not physically printing cash, but the effect is the same. They are increasing the amount of new money in the system, effectively monetizing the government's debt.
So let's use your water metaphor from our pre-show chat.
I love the water metaphor for this. Think of the economy as a bathtub. The government's fiscal spending, the deficit, is like turning on the faucet. More money enters circulation. The Fed's action, QE, is like cranking up the water pressure control. By buying the debt, they increase the amount of new liquidity, more water in the tub, which naturally leads to inflationary pressure.
And inflation is the silent killer of the dollar's value as a store of wet. If international investors, say the Central Bank of Japan, see the US Treasury and the Fed acting in coordination to finance massive deficits with monetary injection, they have to ask, is the dollar still a reliable store of value?
That's the exact question. And if that confidence erodes, they seek alternatives: gold, other strong currencies like the Swiss franc, or alternative assets. When they reduce their purchases of U.S. debt, or worse, start selling, the dollar's exchange rate weakens against everything else. This is where the tug of war between fiscal policy, the government spending, and monetary policy, the Fed controlling the money supply, is fought. And that tension defines the dollar's future.
Let's talk about the timeline, because this is where the market gets counterintuitive. You note that, paradoxically, a huge fiscal deficit can actually strengthen the dollar in the short term. How can more debt lead to a stronger currency?
It's the deficit paradox, and it's pure supply and demand for bonds. When the Treasury runs a deficit, let's say $1 trillion, it must sell $1 trillion in bonds. That's a dramatic increase in the supply of the debt. To attract enough buyers globally to swallow that immense supply, the Treasury has to offer a sweet reward: higher interest rates.
So the interest rate on the U.S. bond goes up.
Correct. And to buy that U.S. Treasury bond, a European or Japanese investor needs dollars. They have to convert their euro or yen into USD first. That sudden, massive global demand for dollars, driven by the need to invest in the U.S. financial asset, temporarily strengthens the dollar. This is why the dollar often acts as the safe haven asset during global crises. When the world trembles, everyone flees to the biggest, safest-looking house on the block, even if you know the owner has terrible credit.
That's fascinating. It's like running to the biggest, safest-looking house on the block, even if you know the owner has terrible credit.
Exactly. It's the best house in a very scary neighborhood.
But that short-term strength eventually gives way as the debt accumulates to the long-term risk, the erosion of global confidence. What does that long-term erosion look like? What are the existential threats?
This is where we talk about the sustainability of the historical album we mentioned earlier. If the debt continues to grow uncontrollably, if those interest payments start consuming a massive share of our tax revenue, the global market fears two things. First, massive inflation. That's the risk that the Fed is forced to print money to monetize the debt to avoid an outright default. That drastically weakens the dollar and erodes the wealth of everyone holding it.
And the second threat?
The second is a credit downgrade. We saw this happen in 2011 when S&P lowered the U.S. credit rating from AAA to AA+. It was a huge warning sign that the risk of non-payment, while remote, was no longer zero. When that happens, bonds lose their appeal, and with them, the dollar. The key for the dollar is not the absolute amount of debt, but the trajectory of that debt and the political will to control it.
I want to touch on a specific historical case study you mentioned, the twin deficits of the 1980s. What lesson can we draw from that era?
The 80s were a perfect example of this paradox. We had a massive fiscal deficit from tax cuts and high defense spending, combined with a large trade deficit. We were importing far more than we were exporting. Initially, the dollar soared. The government was trying to finance the fiscal deficit by offering high interest rates, which sucked foreign capital into the U.S., increasing the demand for dollars.
So short-term strength, but then
the exchange rate rose so high that it made U.S. exports too expensive for the rest of the world. That fed the trade deficit.
It became a self-correcting but damaging cycle. The lesson here is that the dollar's reserve status provides a temporary shield, but chronic deficits are like a slow, constant degradation. If the rate of indebtedness grows faster than the long-term rate of economic growth, our GDP, the question is not if the dollar will weaken, but when the final catalyst will arrive.
That's a serious insight, and it brings us directly to the investor's perspective. Our listeners cannot control Congress or the Fed, but they can control their portfolios. Jane, what are the actionable defense strategies for a proactive investor who sees this long-term fiscal risk?
The answer is always prepare, don't panic, and above all, diversify. The biggest mistake is having excessive exposure to just one market or one currency. We need to move beyond the dollar.
How do we start?
We start with real assets. These are your anti-inflation shield, assets that no central bank can print. Think of income generation